Welcome to The Drawdown, a podcast by Bekaert's private equity practice. In each episode, we explore the latest trends in the private equity sector, as well as challenges and opportunities in the ever-changing investment environment.
Hello, and welcome to The Drawdown. I am J.C. Tuthill, Managing Director with Bekaert in its Forensic and Dispute Advisory Services team. Today, we will be addressing the importance of business interruption insurance coverage, how it works, and whether your portfolio companies have adequate business interruption coverage and the process that should be followed in the event of a loss. Business interruption coverage can cover losses resulting from weather events such as hurricanes, tornadoes, fires, and earthquakes, as well as other types of interruption in business such as power outages or actions by civil authority. There are other specific coverages that may include coverage for events such as cyber attacks or pandemics, but these would be the subject of another drawdown. I'm joined today by Lori Smith, partner in the FDAS practice, and John Collier, managing director. Lori and John are both CPAs with combined experience in the forensic field of over 50 years. So let me begin today by welcoming Lori and John.
It's good to be with you, JC.
Thank you for having us.
So John, let me start with you. If you would please take a moment and share with our listeners the most significant business interruption issue facing businesses resulting from natural disasters and other casualty losses like hurricanes.
Sure, JC. As you know, business interruption insurance is extremely complicated, and therefore business leaders and portfolio managers often misunderstand it. Among the most significant issues are either the lack of business interruption coverage or inadequate business interruption coverage, which can result in a company going out of business because they're underinsured and are significantly impaired financially. Therefore, we recommend that business leaders, including private equity portfolio managers, understand how business interruption insurance coverage works.
Lori, let me turn to you. Can you share with our listeners how business interruption insurance defines what insurance companies will pay claimants for their lost profits associated with a covered event?
Yes, JC. Typically, a business interruption policy will state that the insurance company will pay for the actual loss of business income that the business sustains due to the necessary suspension of its operation during the period of restoration. It's also important to understand that business interruption insurance coverage is part of a business's property insurance policy and is not triggered until there's what was called a covered cause of loss. A covered cause of loss is a suspension of the business operations that is caused by direct physical loss of or damage to a property at the premise. That's typically described in the insurance policy of the business where the suspension has occurred. What this means is that a business cannot claim a business interruption loss. It must have experienced an insured loss, such as damage to its insured property under its insurance policy. If there's no claim for property damage or another provision of the policy that provide coverage, the business interruption coverage does not kick in.
John, how can business leaders and portfolio managers understand the business interruption insurance coverage that they have in place, either at the fund level or within their portfolio of companies?
Well, the first place that you should look is the declaration page, which is generally in the front of an insurance policy. Here, there's a summary of the business insurance coverage, including the types and dollar limits of the coverages. You'll also find the amounts of deductibles and waiting periods that may apply before the business interruption loss calculation can even begin. Other important coverages and limitations that you may find on the declaration page include whether there's a coinsurance clause, which could limit the amount of a claim if the property covered under the policy is underinsured.
Lori, who calculates the claimant's business interruption loss?
The insurance company will typically hire a forensic accounting firm to calculate a claim. But be sure to keep in mind that the insurance company's forensic accounting firm does not represent your fund or your portfolio company as an insured. Therefore, you should hire your own forensic accountant with experience in calculating business interruption losses to represent your interest and calculate your loss independently of the insurance company's forensic accountant. This process should begin prior to the insurance company forensic accountants beginning their work to ensure that all the facts and circumstances are identified to provide you with the maximum coverage offered within the insurance policy, and that all attributable losses are considered in the calculation of the claim. You should collaborate closely with your own forensic accountant to ensure that both of you are aware of all the applicable provisions of the relevant insurance policy or policies and the facts in support of it to maximize the amount of the claim under the terms of the applicable policy. An important coverage you may have is claims data coverage, and this pays for the cost of your forensic accountant to compile your claim. Not all policies will offer this coverage, and where possible, it should be negotiated up front by your insurance agents before your policy is issued. Where claims data coverage is not available, your forensic accountant may seek and recover certain forensic accounting fees as part of what is known as extra expense coverage.
John, can you explain what types of losses are generally covered by a business interruption insurance policy?
Sure. Lost profits are often defined in business interruption policies as the net profit or loss before income taxes that would have been earned, except for the impact of the insured event, plus continued normal operating expenses. This includes or excludes ordinary payroll, depending on whether ordinary payroll is provided for in your policy. Now, these lost profits should not include the revenues that likely would have been earned as a result of an increase in the business that happened as a result of the impact of the covered cause of loss. There's also another way that insurance companies calculate lost profits. The second method entails calculating the amount of the lost profit as lost revenues during the period of loss minus the non-recurring expenses, we call these saved expenses, that do not necessarily continue during the period of loss.
So do these two methods result in the same amount of lost profits?
If they're done properly, the results should be the same, J.C.
Understood. John, you mentioned ordinary payroll earlier. Can you please explain what ordinary payroll coverage is and how it can impact the amount of a claim?
Sure. Ordinary payroll means payroll expenses for employees, except for officers and executives, department managers, and contract employees. The reason that ordinary payroll coverage is important is because it will pay the cost of employees other than those I mentioned before if the company wants to keep them employed and paid during the period of loss.
Lori, how does the insurance company determine the period of loss during which they will calculate the amount of a claimant's lost profits?
Period of loss is often stated in the policy declaration page and is based upon the policy provisions that were agreed upon between the business's insurance agent and the insurance company at the time the policy was issued. It's typically comprised of two periods, the initial period of restoration and an extended period of indemnity. The initial period of restoration is often limited to a 12-month period that extends from the date of the physical loss or damage until the date the property was restored, or a limited number of months allowed by the policy, whichever occurs first. The extended period of indemnity is often defined in the insurance policy and follows the initial period of restoration for an additional number of days allowed by the policy. The purpose of this extended period of indemnity is to allow the business to return to its level of operations as it was prior to the event. That is, to get its doors open and ramp up its business operations.
So, John, now in addition to lost profits, let's talk about what insurance companies will pay in terms of extra expenses. Can you explain how this coverage works?
Yeah. Most business interruption policies will reimburse the claimant for what is defined as extra expenses. These are the expenses that the claimant incurred that were necessary to avoid or minimize the suspension of business during the period of restoration. These are expenses that would not have otherwise been incurred had there been no loss at the described premises or the temporary replacement premises. Examples of extra expenses are things like generators to keep the power on and other expenses to keep the business running and mitigate the amount of its loss.
Lori, what happens if there's no damage to property at the insured premises and thus coverage is not triggered, but the business cannot resume operations because of, say, an official government action of civil authority that prevents the business from returning to its insured premises and reopening.
JC, this is an area that we know well because of our offices were in downtown New Orleans during Hurricane Katrina. As many of our listeners may remember, the city of New Orleans flooded because of Katrina, and the government declared a state of emergency and issued an action of civil authority, which prevented access by businesses to their described premises. In cases like this, many insurance policies provide civil authority coverage for a certain period, like 30 consecutive days.
John, do business interruption insurance policies cover lost profits due to utility failures?
In some cases, they do, when coverages may apply to either what's called on or off-premises power failures. These are very technical and tricky coverages, though, so it's important that they be carefully explored, and they've got to be defined within your insurance policy to avoid coverage issues after a loss.
Lori, can you explain what dependent property coverage is?
Yes, this is where a business sustains lost profits because of another property being damaged. An example of this is where a doctor's office or clinic incurs lost profits because of a hospital where the doctor operates is closed due to a casualty. This is especially important coverage that is often overlooked by businesses and their agents, and as a result, they incur uninsured losses.
John, let's talk for a moment about insurance policies in general. They are extremely complicated, and as a result, they are often not clear-cut. How do you deal with that?
Well, you're exactly right, JC. Insurance policies are extremely complicated and technical, and it's especially important that when reading them, you make sure that you read the defined terms and have the entire policy available to you, including all the endorsements, riders, and exclusions. These are legally binding changes to an existing insurance policy, and they can add, modify, or even exclude coverage altogether. Thus, you need to make sure that you identify these areas and read them carefully, as the coverage you think you have in the policy may not be the coverage that you have when you consider these riders and endorsements and exclusions. Now, insurance policy exclusions specify which events or risks are actually not covered by a policy. They're a standard part of insurance contracts, and they can vary by policy and carrier.
John, so what advice, or do you have a list of steps that you might set forth for our listeners when one of its companies has a business interruption, whether it's a fire, hurricane, tornado, or earthquake?
Sure, JC. And you know this. We always advise our clients to, first take a proactive approach in working with your insurance agent and your forensic accountants to understand your insurance needs and seek the best possible coverage before a loss occurs. When a loss does occur, immediately report it to your insurance agent. They'll report it to your insurance company on your behalf. Next, make sure you mitigate your losses. Try to minimize the amount of downtime and lost revenues your company incurs. Next, engage forensic accountants to immediately begin assessing and calculating the claim. Authorize them to work with the insurance adjuster and the insurance company's forensic accountants. You need to have company management cooperating with the insurance company as well and the insurance adjuster, providing necessary information for the claim in coordination with your forensic accountants. This is important because before company management answers questions of the insurance company, they need to be careful that they understand the implications of their answers so that they'll be accurate and consistent with the insurance coverage. If in doubt, they need to seek the advice of their agent, the forensic accountants, and counsel. And finally, file a proof of loss with the assistance of this team. Your agent, the forensic accountants, and attorney will help you through this process as necessary.
Thank you, John. Those steps seem very helpful. So this concludes our episode. Thank you, Lori and John, for joining us, and thank you all for listening. If you have any questions about this episode, please feel free to reach out to us on our website, cbh.com.
Thank you for listening to The Drawdown, Cherry Bekert's private equity podcast. The views presented by our guests do not necessarily represent the views of their respective firms. For more information on how Cherry Bekaert serves as a guide forward to private equity funds and their portfolio companies through accounting, tax, and advisory services, please visit cbh.com.